All right, today we're going to tackle a term you've probably heard thrown around a ton, implied volatility, or just IV for short. People call it the market's fear gauge, but what does that really mean? What's it actually trying to tell us? So, yeah, what is the market afraid of? Well, think of implied volatility as the market's best guess. And here's the key thing, it's not trying to predict which direction a stock will move. Nope. It's all about guessing how wild the ride is going to be.
So here's how we're going to break this down. We've got 5 sections lined up for you. We'll start with the basics. What is this thing? And we'll work our way all the way to busting a pretty common myth about trading around earnings reports.
Okay, let's dive right in. First up, we just need to get a really simple, solid definition for what implied volatility is.
So in the simplest possible terms, IV is not about whether a stock is going to go up or down. Forget direction. It's all about how big the market thinks the price swings are going to be. Think of it as a measure of expected motion, not the direction of that motion.
So where does this number even come from? I mean, it doesn't just pop up out of nowhere. It's actually a direct result of what's happening in the options market.
Okay, this comparison it's perfect. Look at this. You've got Pepsi and Union Pacific. Both stocks are trading right around the same price, right? But check out the option prices for Union Pacific. They are way more expensive. And because of that, its implied volatility is almost double Pepsi's. This just perfectly shows you that direct link between how much options cost and what the IV number is.
And this leads us to probably the most important point to get right. It's a super common misconception. People think high IV causes high option prices, but it's literally the other way around. Option prices come first. All that buying and selling, that's the supply and demand, that is what creates the IV reading. So when a ton of people want to buy an option, the price goes up, and boom, the implied volatility reading goes up right along with it. To get a little more specific, IV really represents the amount of what we call extrinsic value that's packed into an option's price. That's the part of the price based on time. So when there's a lot of uncertainty, traders are willing to pay a bigger premium for that time, and that inflates the extrinsic value, and therefore, the IV.
Okay, great. So we know IV comes from option prices. But if you see an IV of, say, 39%, what does that number actually mean for the stock? What is it telling you?
And let's stick with that number, 39%. We're going to use a real-world example here. At one point in time, Netflix had an implied volatility of 39%. Right, so what does 39% actually mean? It's not just some random abstract number. It actually gives us a statistical range of possibilities that the market is expecting.
So that percentage, it represents something statisticians call a one standard deviation range. What does that mean for us? Well, in market speak, it means the market is pricing in about a 68% chance, so, roughly 2 times out of 3, that the stock's price will end up somewhere inside this expected range over the next year.
Let's bring it back to Netflix. When it was trading at $370 with a 39% IV, the market was basically saying, hey, there's a 68% chance that 1 year from now, this stock will be trading somewhere between about $228 and $520. I mean, that is a huge range, and it tells you everything about how uncertain the market was. So to kind of wrap this section up, it's pretty simple. Low IV means the market is expecting a tight price range, so options are cheaper and uncertainty is low. High IV means the market is bracing for a wide price range, so options get more expensive because uncertainty is high. Make sense, right? But here's the thing. Just seeing a number like an IV of 50% doesn't really tell you the whole story. To make any sense of it, you absolutely have to have some context. So if I ask you, is 50% IV high or low, the only right answer is, well, it depends, right? Is 50% high for some boring old utility stock? Yeah, for sure. But is it high for a tiny biotech company that's waiting on a huge FDA announcement? Maybe not. It's all relative. We have to compare a stock's current IV to its own history. And traders have a couple of main tools for this. First, there's IV rank. That just tells you where the current IV is sitting compared to its highest and lowest points over the last year. Then you have IV percentile, which tells you what percentage of the days in the past year had an IV that was lower than today's. They sound really similar, I know, but one of them has a really big flaw. And here's where we get into that problem. IV rank. Well, it can be seriously misleading sometimes.
Okay, so just picture this. There's a huge market panic, right? And volatility goes through the roof, just a massive single spike. Well, for the next whole year, that one crazy day is going to completely warp the IV rank. A future reading that is still historically super high might show an IV rank below 50%, making you think it's low and it's really not. But IB percentile, it doesn't fall into that trap. It looks at how often IV has been at a certain level, which gives you a much, much more honest picture of whether today's volatility is actually high or low.
All right, we've made it to our final section. Let's put all this knowledge to work and bust a really common and frankly, kind of a costly myth that a lot of people fall for when it comes to trading earnings.
Oh, it's such a tempting idea. Everybody knows that uncertainty, and with it, IV, goes way up right before a company announces its earnings. So the thinking goes, can't I just buy some options before the report, watch the IV rise, and make an easy profit? Well, the data says not so fast. Just look at this real-world data from United Airlines. In that last 24 hours before their earnings call, the implied volatility absolutely skyrocketed from 72% all the way up to 85%. You'd think the options would be worth more, right? But look at the price of a straddle. It's a common option strategy. The price actually went down by 6 cents. So what on earth is going on here?
So here's the big twist. That jump in IV, it doesn't mean the option's actual dollar price went up. It rises because the option is basically defying time. See, normally an option bleeds a little bit of value every single day. We call that time decay. But right before earnings, everyone is expecting a huge move. So that option just stops decaying. It holds its value. And if you think about it, an option that isn't losing value as time ticks by is, by definition, more expensive relative to the time it has left. And that mathematical reality is what forces the IV number to go higher.
So, at the end of the day, implied volatility isn't some crystal ball that's going to tell you where a stock is headed. It's just not. Instead, you should think of it as this incredible gauge of the market's collective mood, its anxiety, its expectations. So the question you should be asking isn't where's the stock going to go, it's what story is all this uncertainty telling me right now?